Yo, what's up, everybody? RJ back. Educational vid, steady trades. Welcome. Hope you guys are loving the content we're making for you guys. Um, so today we're gonna go over how to select the correct options contract. Right? I think people complicate the hell out of this. They think there's some magic potion, when in fact it really is very simple. Um, and I'm going to go over just a few key points on how we teach and what we think is the correct way or what the correct contract is for you to purchase. I'm going to use Robinhood today to show you guys. I don't trade in Robinhood. I do have some money in here I need to remove, or hell, I might even try to grow a small account. I don't know. Um, but I'll go over Robinhood just because their layout is just, I mean, it's easy, right? Everything is kind of just there for us or whatever. So the guts of a contract. Thinkorswim or Webull is a little bit more intimidating looking for people, but once you get the hang of it, it's pretty easy. So I'm gonna go over how to pick a correct contract, things to look for and stuff like that. Very basic stuff, but I think it's paramount for people because they are wanting to buy very cheap stuff out there. So we're looking at Facebook Meta call options that are expiring August 19th, which is tomorrow. Hence the reason why these prices that are hovering near the share price are so cheap. So, you hear the terms at the money, out of the money, and in the money. And the way that we like to teach it, or the way that we like to purchase contracts, the way I like to purchase contracts, I like buying at the money contracts. And so at the money would be right here in this area right here. So the share price is 175. The 177.5 strike would be at the money. And then the 180 would be out of the money since we have yet to achieve this share price, right? So all I do is I open up a ticker. So in this instance, we're opening up Meta contracts, and I open up the at the money contract, and the first thing I want to see is a tight spread, right? I don't want my spread to get too wide. For me, I like $10 max, $5 to $10 max. I love the stocks, the big tech stocks, because typically their spreads are going to be pretty tight. $2, $3, $5. Easy. I want a tight spread. We'll keep that at that. Volume and open interest aren't too paramount for me because I'm trading very liquid stocks. But if I step out of the norm and go trade something that I don't ordinarily trade, then I will pay quite a bit of attention to volume and open interest. I like IV to be a little higher than this typically, but I know Meta moves pretty well. I don't mind 43% IV on this contract. It's great. I'll take it. I like 60, 70%, but that's just my preference. Greeks, for a day trader, for us, all I want to see is delta over 0.3, right? So I want to see a 30 plus delta. For day trading on weeklies, that will pretty much take care of what I need. However, once we get into the latter part of the week, which today is Thursday, you can see theta is significantly increased, right? I mean, almost the entire value of the contract. So as a beginner, the correct way to select a contract would be to click out and go next week. Now, when we find a 30 delta contract on Meta next week, it's probably going to be right here. Exactly. 34 delta is going to cost us $228. We only have a $2 spread. IV's at 40%. It's a perfect contract. We're buying, and look at theta. It's half of, actually less than half of what it was on the other contract. So we spend a little bit more money, but we buy a ton of space, right? A ton of comfort, and we would carry the same delta, right? We'd have to spend a little bit more money, but that comes with it. For anything worth it in life, you have to put up some money. So from that regard, if it's a Thursday or Friday and you're new to trading, absolutely do not trade daily contracts. Same day, 0-day expiration contracts. They will wreck your account. If you do, my advice is to size down. If you normally buy 5 contracts, maybe you're only buying 2 if you're trading a Friday and you're buying same day expirations. My advice is still to avoid them at all costs until you're familiar with how they move, because they are extremely volatile. And if you don't believe me, you can just paper trade it and watch. It is not difficult to get 100% return on a Friday. It is also not difficult to lose 80% on a Friday, right? So beginners, go out at least a week. Try to keep your delta over 30. Try to keep your bid and ask spread pretty tight. If you're trading something that's not as popular as big tech, look for the contract that's got some decent volume and open interest. Keep it basic. Keep it basic. We just like to stay near the share price. We want to stay right near the money. I don't like to buy in the money contracts because I feel as though they're sort of inflated already. They've already achieved, the price has already been achieved. The delta is significantly higher. Any pullback or regression from this 175 strike is going to severely hurt this premium. So for that reason, I stay away from in the money contracts. I will purchase some of those on a Friday if I'm doing some 0-day stuff. But more often than not, I'm buying at the money, out the money, 30 delta contracts across the board. That's what I like to do. It's how it keeps me safe. I have familiarity with those contracts, and that's my approach. That's what I think you should do. If you have any questions or need some clarification on anything, feel free to reach out. Like I said, we offer the classes. Just contact us. Have an amazing evening. Thank you.